Everyone, it's a pleasure to be with you here today. My name is Thomas Hale. I'm an associate professor here at the Blavatnik School of Government, and we're here tonight to talk about officially supported trade finance, challenges and opportunities in times of crisis with Professor Andreas Classen, who I'll introduce momentarily. But just to set the context for tonight's talk, we were talking before, it's quite typical and really cliche to start a talk about the global economy by saying the global economy is in crisis. But actually, it seems to be more true than usual at the moment, whether it be around the after effects of COVID-19 or the ongoing effects of COVID-19, the war in Ukraine, longstanding challenges around climate change, geopolitical contests, etc. And so many governments, many populations are looking to policy tools to think about how do we try to navigate this tempest? How do we get a bit more control over the international economic flows that shape the prospects for prosperity in our countries? And in that context, sufficiently supported trade finance is actually a really important one that not too many people, I would say, the common person in the street would raise their hand and say, I know exactly what that means. So we're really lucky tonight to have a chance to think about how this quite important policy tool, which usually shapes the world economy that we all live and operate in, how that works and how it might be used even more effectively going forward to respond to the crisis we see before us. I'm delighted that Professor Andreas Classen is able to join us to talk about that. He's really probably the world's leading expert on this subject. He's currently a visiting scholar here at the Blavatnik School, but his usual job is as Professor of International Business and Director of the Institute for Trade and Innovation at Offenburg University in the Black Forest in Germany. And he's the author of many publications, too numerous to mention, but I'll just highlight the Handbook of Global Trade Policy, The Future of Foreign Trade Support, and he was a contributor to a book called Beyond Gridlock that I have played a role in as well, which is a great pleasure. Andreas is a regular interlocutor with export credit agencies, with trade development institutions all around the world. He speaks, I think, to about 10 governments a day on these questions, as far as I can tell. And he's highly sought after as an advisor to governments, but also a thinker for people in the private sector and how to navigate these kinds of contexts. And of course, that draws in his academic expertise, but also his experience as a practitioner, which is a nice and all too rare marriage of two different skill sets. In former life, he was the head of the PwC Economics and Policy Lead for Germany, and also served as a co-head and managing director of the official German Export Credit Agency and Investment Guarantee Agency. So you've seen these issues from the round. So we're going to start off with some remarks from Andreas for half an hour or so, and then just move into a discussion. Those of you online, I hope you'll have a chance to be able to ask your questions in the Q&A function. Those of you in the room, please just jot them down, and we'll look forward to getting to the conversation shortly. But please join me in welcoming Andreas.
Thank you very much, Tom, for the kind introduction, also for the invitation to contribute. I'm absolutely delighted to be here at the University of Oxford and to have 1 hour with you, both here in the room at the Blavatnik School of Government, but of course also online, regarding officially supported trade finance. And as you said, there's always a crisis, but we can say there is a significant crisis regarding trade and trade support. But the good thing is there are also a lot of opportunities and solutions. I have to say that, as you heard, I have been heavily involved in these topics for the last 20 years or so, and I'm still absolutely excited about it. And I think you can be as well, because it's a very interesting, it's a fascinating, it's a very relevant topic. I have to be honest that when I said to my daughters what my lecture today is, they were somehow excited as well, but that's okay. They're too young maybe to fully understand what that means. So if we think about the next 30 minutes, the journey I want you to join me is with 4 different destinations. So I know a lot of colleagues online or here in the room are experts on trade, so I don't want to bother you with the background on trade, but some people might say, oh, I'm not really an expert on trade and economic development. So I do a very, very quick overview on the importance of trade and economic growth. We then speak a bit about trade finance and the instruments to just do a right framing regarding what we want to talk about in more detail. And then we will discuss the officially supported trade finance instruments, focusing then, that's our destination number 4, on the challenges and the opportunities. So if we kick off and think about trade and the relevance of trade, I think there is no surprise that trade is and will be a key driver for economic growth. That's not a most recent understanding. Of course, it's very old. And if you think about why countries trading have growth, have positive impact regarding jobs, etc., that's something already Democritus find out a couple of hundred or thousand years before. And then, of course, you know, if you remember your economics or business background, that there is something on the importance of trades described by Adam Smith. And then we have the comparative advantage discussions regarding Ricardo, when he focused on the productivity, the labor productivity, then adding the labor and capital ratio plus land as well. And at the end, we understand there are positive outcomes. Both sides of a trade transaction benefit usually when trade is voluntary. So there is a positive effect. But there are a lot of challenges regarding this positive effect at the moment. And I just want to highlight 5. The first one, the most obvious one, of course, is the Russia-Ukraine war. In addition to all the human suffering we see, the war has a significant effect regarding trade. And if we just look at the latest numbers in the forecast from the World Trade Organization, the WTO, we see that the prediction is now that we have a 3% merchandise growth regarding trade in 2022. The previous forecast was 4.7%, and we will see what happens in reality. So obviously there is a significant effect. Quite obvious why, because of course we have the prices for crude oil, for natural gas in a really, really different sphere. But it's also that if we think about all the other different dimensions regarding regions, I know it's very difficult to read, that's not the idea, it's just a bit of an idea of what happens, that there is a significant and negative effect. But that's not the only challenge. We are somehow in a post-COVID environment. Yes, true. We don't wear masks and we can travel and we can sit together and eat together. But of course, the global supply chains and the challenges regarding the post-COVID situation is very, very tough for a lot of exporters. And we see that when we think about consumer prices, inflation, etc., etc. A 10-15-year development is exactly about this multipolar, fragmented world. If we think about different trading blocks, if you think about nationalism, populism, and how governments use trade in a positive and negative way regarding their own economy. And of course, we shouldn't forget that we have a new world regarding business models. So digitization is the name of the game. So what you had to do in the past, producing stuff in your own country and then export it, now that's or can be very different. You can just send data from, for example, the UK to Brazil, print the stuff in a 3D printer, and then you have the goods in Brazil, so you don't have to do merchandise exports. So long story short, a lot of challenges. And another key question now is, how is that related to trade finance? So before we discuss that, I think we have to briefly define what trade finance means in general. First, some numbers to understand the significance of trade finance for economic growth for trade. So if we think about overall volumes and the 2020 numbers, for example, $22 trillion world trade in goods and services. The estimation is that 80 to 90% of merchandise trade is somehow related to financing or risk mitigation instruments. So a huge number. And that's the reason why we always say trade finance serves as the lifeblood of international trade. So without financing, trade would not work. 80 to 90%, quite significant. The problem is that there is not a lot of financing, only there's also a huge financing gap. And that gap, according to Asian Development Bank estimations, is approximately 1.7 trillion per year, or it was at least in 2020. So you can say now, yeah, I mean, that might be a good reason because it's not worth to do financing, et cetera, et cetera. The problem is that there are a lot of transactions which could happen, in particular in developing countries, but they do not work because of the trade finance gap. And there is a reason for that. Before I discuss that in detail, I just want to give you an idea what these trade finance instruments are, because some people just say, oh yeah, trade finance sounds not really familiar. So usually we have a definition of trade finance and export finance. And trade finance usually are instruments for short-term financing up to 1 year, which means you are an exporter from the United Kingdom, for example, and you want to sell something to Romania, and your buyer receives the good, but doesn't want to pay immediately, only after 30 days or 60 days or 90 days. So what you basically do as a supplier, you give a supplier credit to your buyer. And the reason for that is, number one, you want to sell the perfect product. So it's about quality. Number two, of course, it has to be a good price. And number three, this trade finance increases your competitiveness with regard to other exporters. So it's a quite important aspect of competitiveness. There are other short-term trade instruments where you involve banks, commercial banks, and the standard instrument is called LC, a letter of credit. So it's a security for the exporter to get the money and makes it easier, but it is quite expensive sometimes. And that's the reason why it can be challenging as well. But anyway, short-term trade finance means usually for agricultural goods or for textiles or these type of things, you sell something and you receive the money somehow later. Medium and long-term export financing instruments are often more complex. We call them buyer credits or asset-based financing or project finance. Why is that? If you sell, for example, a machine, a tool, a tunnel boring machine from Germany, the famous producer Herrenknecht close to Offenburg, this tunnel has to be created, let's say, for example, in Kenya. And the buyer has to generate revenues after finishing the tunnel, for example, with a toll road. And a tunnel boring machine is quite expensive. And that's the reason why the buyer should create revenues and then is able to pay the tunnel boring machine with a repayment period, for example, of 3 years or 5 years, or maybe even 8 years or 10 years. It's a bit more complex. That's the reason why you usually involve a bank. So you have an agreement between the importer and the exporter, and the commercial bank is involved, giving the loan to the importer. The exporter receives the money immediately, and the loan is repaid plus interest over the next 5, 6, 7, 8 years. Sounds simple. It can be, but the bank might say, Kenya is a bit of a risky country. The volume is too high. And also it's too long. I don't like 8-year repayment of loans in Kenya for 50, 100, 150 million. I am not in. Which creates market failure. Classic argument that something should happen because it's beneficial, creates economic growth, jobs, development, etc. But it's not going to work. Why? Because there is some miscalculation or misinformation about costs and benefits of that exporting transactions. And that's what we usually define as information failure. And there are some others like coordination failures. So again, make it simple. Commercial actors, both on the financing side, but also on the risk mitigation side, are out and will not support that transaction. And as you see here on the right-hand side, major barriers are lack of access to finance. That's the most important problem for at least businesses in developing countries or LDCs, a lack of access to finance. And it's a significant problem for small and medium-sized enterprises. And as we all know, these SMEs usually create a lot of jobs. They create positive impact. We can think about inclusive trade, women entrepreneurship, in particular in LDCs and developing countries. So it is a problem. And it shouldn't be a problem That's at least what some governments thought over 100 years ago. And the British government, by coincidence, was the first one who thought, oh, we should do something for economic development and trade. That's the reason why we create an institution called Export Credit Agency. And today's name is UK Export Finance. So the overall idea is we support our exporters with risk mitigation, i.e. insurance or guarantees, and or financing. And this is part of an overall trade policy or strategy of the government. And that's the first interesting development, that this strategic approach is now much more relevant, that governments in a very strategic way use these type of instruments for innovation policy, for industrial policy, or of course for trade policy. And you just see three examples: Armenia, Sweden, and Switzerland, just recently finalizing their strategies. But back to our ECA instruments and what they do, make it a bit more concrete. So the first point I want to make is, why are governments using taxpayers' money, your and my money, to support exports? They have an opportunity to intervene for the public benefit. Why is that? Because the main idea was to say, we want to create jobs in our national economy. That was the initial aim, to say, if I support a British exporter with regard to this transaction, he will not fire 10, 50, 20 people, or he will even hire more people and create more jobs. And that's good for our economy. So that was the initial idea. In an additional way, responding to market failure, and also creating catalytic effects, which means because I am in as the government export credit agency, others, commercial players, will follow, either in a co-financing deal, or I insure and you, the commercial player, give the liquidity, or in a follow-up deal, you have the evidence that this transaction worked. Now you can do it as well, because you see there was no problem, so you can follow. That's the idea of signaling effects. So two main intervention principles are, I want to be additional, and I want to be catalytic. So not crowding out the commercial private market, but crowding in the private market. What is new now in the last 5, 6 years, and in particular today? New is that the traditional way how governments intervene is still there, but they add a lot of new aspects. They add, for example, the aspect of innovation support. So what governments and these institutions want to do is they want to support innovative exporters developing new technologies, see new markets, and step in with additional instruments. They think about, in a net zero environment, we have to help our exporters to create new technologies regarding climate finance and climate action. And that's the reason why governments systematically extend their offerings, for example, regarding innovation and climate, and new agencies and merged institutions are there. So you might remember that I said the first ECA was created in 1919. You see the Asian Development Bank on the right-hand side, the logo. ADB is currently developing a new multilateral export credit insurance and investment guarantee institution with up to 18 member countries. Exfin is a new institution in Norway, where the government merged the existing finance and the existing insurance institutions, and there is a new agency. The Dutch government created a new development finance and export finance institution called Invest International, which is active now, combining development financing and export financing. And last but not least, the World Bank supported Mongolia, creating a new export promotion, export finance insurance institution, in particular for small and medium-sized enterprises. So a lot of things happening regarding new institutions or merged institutions, but also a lot of things happening regarding new products on climate finance, on innovation, etc. The relevance is obvious because these institutions I just introduced support approximately 13%, 1-3, of global trade, which is around 2.5 trillion US dollars. So it's not a niche topic. It is very relevant regarding trade, and of course also very relevant regarding economic development. And if you think about the volumes that, for example, the German ECA ensures between 20 and 30 billion euros new transactions per year, of course, it's very relevant regarding the budget of the country and at the end, the taxpayers' money. So that's the background and the status where we are. What are the challenges now, and also what are the opportunities? I would like to highlight 4 or 5 main areas of interest. And we start in a multilateral environment and just go down to a policy and institutional and climate perspective. So the first very exciting and also very challenging topic is the international regulatory framework. People who are familiar with trade law, etc., know that there is a World Trade Organization and a subsidy agreement, that in general subsidies are prohibited or actionable, and export subsidies are prohibited subsidies. And this is, of course, an export subsidy, but for people who really love trade law, there is an exemption, and it's called the safe haven. And the safe haven means that if there is an international agreement, and the answer is yes, there is, it's called the OECD arrangement, then you are safe if you provide that support. The challenge is that this safe haven is somehow not that safe, and there is an ongoing discussion how to align these two different instruments. And this is a very topical issue, because when these institutions and agreements were created, we were speaking mainly about highly industrialized countries in the US and in Europe. Now, of course, as you know, we have China, we have India, we have Brazil, strong economies not participating in the arrangement. So being outside this framework, which creates a lot of competition and, of course, a regulatory problem. So one of the key questions is how safe the safe haven is and how we can make it safe again, because the mechanisms in these agreements do not work properly anymore. Under the subsidy agreement of the WTO, you can launch a trade dispute. Under the OECD arrangement, there is no dispute settlement mechanism. There's a so-called matching mechanism. If you are not in line with the arrangement, I am able to match you. And these two different mechanisms, they do not work really properly because it's a different discipline. So that's a bit more technical and legal. More practical is that the ECAs, the institutions, created a lot of new programs. And these programs are pre-export related. That means it's not a supplier credit or a buyer credit, as I explained. It's working capital, for example. It's capital expenditure financing. It's even innovation financing. And these tools are not covered under the arrangement. But if they are exclusively for exporters, they're export subsidies and could be prohibited or at least actionable. And there is an area which has not been explored and which is a significant risk for all these institutions. And just another example, when we talk about net zero commitments, when we speak about a requirement to create new industries, new emerging technologies, we need financing for that. We need support from governments, but climate financing and trade law create new challenges because it is again a subsidy, and we have seen some subsidy cases in the past under the WTO framework. So the two different policy perspectives, they don't match. climate finance activities and trade law under the WTO, there is a challenge. And of course, a big discussion, should we amend the WTO agreement? Is it the right way to do it, et cetera, et cetera. So in a nutshell, on a multilateral perspective, a legal framework, a regulatory framework, we have a lot of challenges, and we have to solve that, because otherwise it will be very difficult in the future to use the instruments in a proper way. Number two, on a domestic level, some countries have been quite successful developing what we can frame as a strategic econ system. What is that? The interaction, the collaboration between innovation instruments, science, R&D instruments, export instruments, etc. Because creating such a national innovation and trade promotion system, for example, in Finland, makes these instruments much more successful. They're aligned, they're more effective, efficient, and this can create another comparative advantage. And there are best practice examples, like Finland, for example, they label that as Team Finland, and others who still work in their silos, similar to 10, 15, 20 years ago, of course, have problems, and their exporters might not be that competitive because this national innovation and industrial policy and trade ecosystem is not existent. So it's a policy issue on the national level, creating disadvantages where it does not exist. 3 out of 5 is, next level, the institutions themselves become much more strategic, at least some of them. And some institutions have developed strategy models based on the theory of change, looking at their input, output, outcome, impact, and using benchmarking tools to be more efficient in comparison to others. So if you still work under the assumption that you are working or responding to market failure, if you're under the assumption that you're additional, if you think you are a lender or insurer of last resort and you don't have to be strategic, again, your exporters have disadvantages because others do not only provide this ecosystem, they also have a strategic approach regarding trade facilitation or creation in their own institution. Of course, it makes sense to look at results. And that's another challenge, but also an opportunity. Traditionally, these institutions were focusing on job impact, and they were measuring their jobs. And it is quite impressive what they do. For example, in Canada, Export Development Canada, the ECA, creates or safeguards more than 500,000 jobs in the economy, which means, if you think about their volumes, 1 million euros of new insurance or financing in Canada creates or safeguards 8 jobs in the economy. Or, for example, in Austria, 30,000 jobs are only there because of the institution. 14 jobs created or safeguarded with 1 million of insurance provided by the Austrian agency. So that's quite impressive and quite successful. On the other hand, is that still the right measurement in the 21st century? Shouldn't we add other stuff as well? And also, we can say we are wonderful and very successful as institutions, but what if the risk we insure or guarantee materializes, such as, for example, now in Ukraine or Russia, that these institutions have to pay claims. They have high volumes in these countries. And of course, I mean, that's the idea of an insurance, that if you have a claim, someone pays. But what about the discussion in Parliament or in the society when there is significant outflow regarding the taxpayers' money and the risk materializes, which is an ongoing challenge. It will be interesting what works. Last but not least, we briefly discussed the climate trade alignment, and this is definitely the name of the game. So green exports are catalysts for innovation, and sustainability becomes a priority for some institutions in a positive and negative way. Negative, that's the challenge. if you agree to a net zero commitment like UK Export Finance or EDC or EKF in Denmark, that means that with your existing portfolio, for example, in oil or gas, etc., you will have significant challenges. And you have to align and think about your own business model. What about the future of your portfolio? On the other hand, the opportunity to refocus the support with regard to green exports, to technology, mitigation, adaptation, etc., of course, is a fantastic opportunity to combine that innovation, industrial policy, and export in an institutional framework driven by these ECAs. Very briefly, the amount required is huge. So we did a study, for example, last year. We found out that the institutions have to increase climate financing 6.8 times by 2030 to at least retain that current proportion relative to other climate finance flows. So it's a huge task for them. And that's only the climate finance perspective we cover. 30 minutes fly. So very briefly, a conclusion and summary. Benefits of trade for economic growth are pretty obvious. I hope you agree. Significant challenges, and it's not only that we say, yeah, there's crisis. No, there is crisis, unfortunately, and the Ukraine war is only the most obvious one. Global supply chains are another issue. Trade finance is the lifeblood, but there is significant failure. There are market gaps, and governments, institutions, ECAs can step in. There are key tools for that, but there is significant change in the landscape and a multitude of challenges. For example, the multilateral framework, safe haven. For example, these national ecosystems. The strategic approach some institutions use and others not. New definition of impact and measurement of that impact. And last but not least, climate finance as well. So you might understand now why I think after 20 years, this is a very relevant, very exciting, and very important topic. Thanks a lot for your attention, and I'm very happy to further discuss with you. And back to you, Tom. Thank you.
Fantastic. Well, thank you, Andreas. That's a fantastic presentation of a topic that most people probably won't have been super familiar with, but one that, as you've laid out very clearly, plays a really important role in the world economy, and one that is going to be an essential part of any navigation of the turmoil they're in. So the floor is open for questions. In the room, please just raise your hand and introduce yourself. If you're online, please just type into the question and answer box you have on the Zoom screen, and I will bring you in through this magical iPad. But I'm going to use my privilege as the moderator just to ask a question to start with, if I may, Andreas, which is about something we hear about a lot these days, which is global supply chains. And many countries in the COVID crisis felt exposed by their vulnerabilities, and that they realized they had fewer sources of protective equipment or computer chips or fuels or other kinds of things that they needed than they might have wanted. And so there's a lot of interest in how to make supply chains more resilient, mostly through making them more redundant or even bringing things from other places back to domestic production. Well, how do you see the role of ECAs in that challenge? Are they able to make supply chains more resilient? Because it seems like some of the things they would, sort of their natural inclination is to help exporters reach more places, but does that add up to something that can be more resilient?
Excellent question. Thank you, Tom. I think it's, number one, I think it is a significant challenge for the exporters, and also, of course, the role and the relevance of ECAs, because you're right. I mean, that's not their DNA. Their DNA is a different approach. We want to export, we want to push export, etc. On the other hand, what ECAs see and have seen is that the reshoring, how I would define it, is something which is ongoing. It has not happened only due to COVID or after COVID. So this trend is somehow ongoing. And of course, digitization plays a role as well. And that's the reason why government institutions, also ECAs, think about what is the right balance regarding their support. And I think that's one argument why these pre-export financing instruments, these somehow different instruments have been created as well. Think about how you could be more active regarding innovative approaches, regarding financing earlier stages as well, and help exporters to rethink their own value chains as well. So helping them with different financing instruments along the value chain, from innovation to capital expenditure, to working capital, to export and foreign direct investment. So that's one thing. And I think the other question related is, I think that ECAs in the future will be a bit more specific regarding the support they want to do. So high technology products where there is really, where it makes sense to foster the trade, there will be more activity. Regarding other stuff where you could think we have to rethink the supply chains, the support might be reduced.
Yeah, I think it's an interesting question to see how that develops going forward, because I think we've seen resilience kind of been dominated by a view of let's take back these things and put them domestically, therefore we have it if we need it. And there's a sort of other perspective which could say, actually, if we have more everything going out all the time from everywhere, then we're actually all together, safer, because everyone's always going to have supplies. So there could be kind of a reciprocal version of resilience as well. Thoughts, questions? The floor is open for observations. Let's start with Ken. Please introduce yourself when you come in.
Thanks a lot for the very interesting presentation. My name is Kennedy Beva, postdoctoral research associate here at the Blavatnik School, University of Oxford. It's very interesting the way you mentioned, given a nice overview of the trade finance landscape, but also touched on some of the issues that are of great public interest apart from economic, for example, climate change and the pandemic. So given the current structure of trade finance in general, do you think it needs to be scaled up to address these issues of public sort of interest or issues of values, or do you think it needs to be transformed so as to be able to deal with these challenges?
Thank you very much, Ken. I think that's a very relevant question. My answer is two different directions. Number one, what the institutions try to do, and some of them very successful, is to cope with these challenges you just described. So when we think about the COVID pandemic and what happened there, we had a lot of liquidity in the markets, much more than during the global financial crisis, for example, the Euro crisis. The problem was that a lot of orders were cancelled. Exporters, businesses in respective countries had to think about, like, how can I finance my working capital, for example, my pre-export stuff? And the response was quite successful and very impressive, if I may say so. So just give you two examples. The Spanish government introduced, only weeks after the outbreak of Corona, a new working capital program, particularly for SMEs. And if I remember correctly, they had more than 400 applications, only 4 weeks. So they were able to support small and medium-sized enterprises in Spain, helping them to continue the work, to produce things, not to fire people, because of these new instruments they introduced in a very easy manner. And number two, the Swedish government also introduced pre-export instruments, both for small and medium-sized enterprises and also for large exporters. And the volume regarding their applications, the first 7 months of 2020, I think increased by 7 times. So a significant response as well. So you see, number one, the question is, yes, there were important tools and they were able to respond to the pandemic as a, let's say, instrument for that particular crisis. So that's number one. Number two, there's also an understanding that the world is really different. And that brings me back to the question of the supply chains. So the idea is, what type of instruments, what type of support is required? How should we change as an institution? What is our answer regarding this new economic environment? Is driving ECAs regarding what they do and how they do it. And some of them, again, are quite successful. UK is a good example, Canada is a good example, also some other governments who think about how should we shift more towards this innovation perspective and what can we do to manage a future requirement regarding technology support, regarding climate, regarding other relevant areas. I hope that answers the question.
Thank you. Very interesting. Further questions? Please.
Hi, thanks, Andrea from the government outcomes lab here at the school. So maybe staying on this question of public interest and wider social value. So my background isn't in trade at all, but thank you so much for such an insightful and clear presentation. But you've mentioned the impact and sort of outcomes measurements of these ECAs. And it seems like one of the key metrics is the jobs created. But I'm wondering whether there's a trend or these conversations in the field around kind of widening the scope of these metrics to kind of factor in wider kind of societal benefits, social value, something that's very prominent in the public policy space in the UK. So I'm just like really curious. I would talk just about number of jobs created. Are we looking sort of a bit deeper, the quality of the jobs, or kind of, you know, like well-being of sort of like workers and so on? Is that part of the discussion, or is that kind of the realm of social policy? We don't need to worry about that when we talk about trade.
Thank you. It's a fascinating topic, and I can tell you we are, or they are, on the way. So first of all, the key metric, the key rationale was and somehow still is number of jobs created, which sounds a bit like 20th century and old style, and it might be. So that's the first part of the answer. But a growing number of institutions are really thinking about the overall impact. So you see sustainability reporting, you see questions of inclusive trade, you see trying to answer the question of technology transfer to developing economies. Women entrepreneurship plays a role, and climate, of course, plays a role as well. So what some governments and some of these institutions try to do, and this is part of benchmarking studies they have produced in the past as well, like Denmark, like Norway, the Netherlands, Switzerland, for example, to have a holistic approach to say, okay, what do we want to know is, what is our output? That's pretty obvious. The amount of insurance or the number of transactions. So that's pretty business driven. But then we think about the outcome as well. For example, how many SMEs are supported? For example, what about the overall export volume we have? For example, what about the climate percentage of our output? But also more qualitative questions regarding other impact we create. And you asked the question, what about the quality of the jobs? Does it make sense only to think about 40, 50,000 of people being employed? Or is it not much better to think about, okay, these are people in specific sectors, well educated, in knowledge-driven economies, and that's what we have to support. So it's better to support 5,000 high-quality jobs in knowledge-driven economies than 10,000 jobs in areas like steel or shipping, which might be not relevant in our economy in 5 years. So there is a very, very, let's say, energetic discussion, I would say. A minor comment as well, that's driven, I think, by the development in the last 2 or 3 years, because I remember interesting responses when we asked an ECA, how many small and medium-sized enterprises did you support last year? Because that's your main policy objective, job creation and SME support. The answer was, we don't know. And I just said, okay, but how could you defend your role in the public sphere if you tell everybody we want to support SMEs, and if I ask you how many, you just can't answer the question? And of course, this is a big weakness for a large number of institutions, but there's a trend towards what you just explained.
And if I just add a follow-up question on that one, you're looking at sort of innovation systems for countries, but what do you think are the main characteristics that make an ECA innovative in this way? So this trend that you're asking about to change the metrics to get beyond the 20th century version. Obviously, some maybe are moving faster than others on these dimensions. Are there any general characteristics you can identify of what makes them more innovative in this way, or conversely less innovative?
How many hours do you have? So allow me to use the model I have just briefly introduced. So what we try to measure in our research work and also in our policy work is to use the 3 main dimensions of direction, execution, and results, thinking about their performance, and of course, performance includes innovation. So maybe 2 or 3 examples regarding the strategy, the direction. Is an ECA aligned with the policy of the respective government? Is there a coherence between, for example, trade policy and climate policy, both from a policy government perspective, but also from a strategic ECA perspective? So that's one question. I would answer the question, you are innovative if you do that, and you might be not innovative if you're just totally in your silo and you're just following the old ideas of the 20th century. Or on the execution side, are you innovative when you, for example, develop new risk models? Might be a bit technical, but is it still up to date to use the risk model in underwriting from 1990, or is it the right way to do a state-of-the-art commercial environment risk management approach? Or, for example, do you have innovative products in your portfolio? And third dimension, the result dimension, that's exactly what Andrea was asking for. Like, are you innovative regarding your performance indicators? Are you measure these indicators appropriately? And are you open enough to benchmark yourself with other ECAs to tell the world, no, I think I'm super. Yeah, you might be not super, but if you compare yourself with others in an appropriate model, then you can give evidence to your stakeholders, to your country, the society, that you are relevant and you do the right thing, if I may say so.
Right. Good to benchmark. Further questions, please.
Yes, my name is Sanusi. In my previous life, I was governor of Central Bank in Nigeria a long time ago. Now, I'd like to ask, my comment has to do with a little bit broadening this subject a bit beyond finance and looking at officially supported trade finance as part of a whole set of instruments for ideological domination in the world.
Yeah.
Because you can't take trade, international trade, outside the context of what's happening in the world. World Trade Organization, you get the unequal trade, the global inequalities, the promotion of exports of products from metropolitan centers of the world to the third world, and the deindustrialization that's happened, not just from Europe and America, but also China, which has become a major player in export credit. Now, the impact of these officially supported trade agencies has been to promote those exports that have led to the deindustrialization and impoverishment of countries in places like Africa. And I think we get into a point where this model is approaching its best before date. Okay, you've got Donald Trump closing off America to China. You've got what's happening with Russia now, and the general fear of the risks that you run in being part of this global infrastructure, and the need to be more internally focused. To what extent can these agencies look beyond promoting exporting goods from Britain, Germany, United States, China to Africa, to how they can promote economic development in those countries, and also so that it's really trade, not just selling, but it's also selling and buying, so that those parts of the world that have been on the receiving end of this should not begin to feel some of the positive impact in real terms of trade, and that then creates an environment for the long-term sustain. I don't know if it's relevant, but the long-term prospects for these agencies, because I really think this is an unsustainable model in the next decade or so.
That's a fantastic question. Thank you for that. I have 2 or 3 different answers to that. So the first answer is, you're absolutely right. There are trade promotion instruments, and if you are a very powerful country with a AAA rating and you can easily support your exporters with significant amounts, of course, that creates a competitive advantage and a disadvantage for economies with a poor rating, etc. And that, of course, helps them to export and to push their trade power. And this is, as a result, of course, something where we have to think, is that fair? Yes or no? So you're absolutely right. The answer, how to improve that or how to make it somehow fair is maybe 3 ideas you allow me to share. The first thing is a global level playing field, to say, okay, if there are rules and regulations allowing the powerful, the rich nations to play in a similar way what others have to do as well, So that if you're not able to give the lowest premium or interest rate, the best possible transaction financing support, but you have the same rules for everybody, like in the OECD arrangement, then at the end, there is no subsidy element behind for strong and powerful countries. There is a level playing field because everybody has to follow the same rules, which is one aspect to make it a bit more fair. A second aspect is that these institutions try to collaborate, but they have to collaborate and they have to help developing economies to create these instruments as well, for example, in a multilateral environment. And I'm pretty sure you know that there are some very strong growing institutions in Africa. One example is African Trade Insurance Agency, located in Nairobi, the headquarters, but as a multilateral institution, which is much stronger than national institutions because of a much better rating and the opportunity to reinsure, etc. And a Frexim Bank, African Export-Import Bank, which really tries to foster economic development. And President Obama he fights for that development in Africa in a very successful way, because if you think about the history of Frexim Bank, where they are today and what they do, that's a strong evidence from my point of view, how to use these institutions also, for example, in Africa. And a third dimension I would like to add, not solving the problem, but maybe just as an additional thought, that some countries, for example, the Netherlands, try to combine that idea of developing finance and export finance to say, we have the idea that we want to support with technology transfer. We really have the idea of impact in the respective country in Africa or in Asia or in Latin America, South America, sorry. But we have, of course, an interest of export promotion as well, but we try to do it in a different way, not with tight export, but really with a development angle and a trade angle. And that's the idea of this new institution called Invest International, which has just been created. So 3 answers, somehow answering your question. Number 1 is level playing field. Number 2 is supporting strong institutions, such as a Frexim Bank with a multilateral angle. And number 3, rethinking your own approach, being more fair and just regarding what you do on export promotion. I hope that answers the question. All right, thank you very much.
Fascinating set of issues, and I think speaks very clearly to this idea of how do we go from this sort of, if I may generalize, sort of a 20th century liberalization is the ultimate objective sort of idea to this more complex landscape now where the economy is not, as your question noted, there's lots of people cutting off trade for various reasons, probably not so much interested in efficiency as the only outcome, but actually how do we use it as a tool to advance climate objectives, development objectives, national security objectives, all the things that people are motivating government. So we'll see how innovative they can be in that regard. I think you probably have time for one further question before we have to close. But any final thoughts? Yes, this is yes, Ken.
Yes, so maybe a very quick question building on the previous discussion. Given that there are many institutions working on this topic, do we have a kind of initiative that tries to coordinate their efforts towards addressing this 21st century questions, or are the various institutions working by themselves?
Yeah, there are different bodies, some of them quite efficient, some of them trying to be very efficient, and I would mention 2 examples. The first one is the OECD, the Organization for Economic Cooperation and Development, based in Paris. And the OECD is not only managing the arrangement regarding this level playing field, there are, of course, also a lot of other related areas, climate and social questions, etc., and creating this forum for interaction for further development. They're discussing the minimum premium rates, for example. So the OECD is a very strong, very powerful forum, because they're extremely transparent. That's the idea behind, so that all the institutions send data and the OECD is able to manage that. So real-time transparency is one of the key success factors why this OECD environment worked. The biggest challenge, of course, as you might already think of it, is that not many countries which are relevant now are participant of these arrangements. I mean, we have, of course, US and European Union, Japan, Korea, etc., Australia, but a lot of growing economies, strong economies like China or India are not participating. But it is a very strong forum to coordinate, to collaborate. The global forum is the Berne Union. The Berne Union is the International Association for Public and Private Export Credit and Investment Insurance, with more than 80 participants from all over the world, including China, Sinosure, for example, including India, including Brazil, Russia, etc. So, and that is a form of exchange of networking. And that's the strength there as well. It's not a forum of international rules and regulations. That's the weakness. The strength is that there is an idea of exchange of information and thinking about global best practices, etc., etc. So yes, the answer is we have these institutions, but with, I would say, significant weaknesses. And that's one of the, for me, the biggest challenge of the 21st century, creating this new level playing field, this global environment, in order to answer the questions you, for example, raised regarding fair and just trade, but also regarding, for example, impact measurement, what Andrea mentioned. So that's a bit of a huge task for the 21st century.
Well, on that note of more to be done, I think we'll take one final observation.
Just to throw something on the table, I think the proper way to think about when we talk about a level playing field. And the example I give usually is if you have a football match between the national team of Brazil and the Nigerian under-16 team. It's a level playing field, but we know who's going to win.
Yeah.
Okay, so in games like polo and golf, you give handicaps.
Yeah.
We have this whole issue of international rules that pretend they feel this level, but really you've got very strong players like the United States and China playing on a level playing field with Nigeria and Zimbabwe. So that field has to be leveled by really looking at the fact that some parts of the world are disadvantaged and they have been historically disadvantaged, and how can they be supported for that field to be properly leveled? Just
excellent point. And there is this initiative, or there was the initiative, for example, with the so-called International Working Group, bringing all these different players. Unfortunately, it's not working at the moment because a lack of transparency, that's the biggest problem. But exactly what you say, like thinking about what is the new level playing field. It's not the level playing field from the 1970s under the OECD arrangement. It's a new level playing field where we have to accept the reality in 2022 and not from the past.
Hopefully Ngozi would help.
Yeah. Inshallah, thank you.
Well, on that optimistic note, let's draw things to a close. Thank you so much for your time and your questions. Thank you, Andreas, for a fascinating talk. We're going to look forward to learning much more about this going forward. And thank you all for your time.